Okay, welcome everybody to today's podcast on reverse mortgages. And I have with me today a special guest. His name is Marco Albanese, and it's a pleasure to have him here. Go ahead, Marco, if you could please introduce yourself to the folks.
Hi, everyone. And Rick, thanks for having me on. This is a topic that's, I think, important to a lot of people these days, and it's definitely one for me. I've been I've been a mortgage agent with Cam Mortgages for the last couple of years. I've been a real estate investor for nearly 27 years. I'm thankful to be reconnecting with you after a few years, especially after getting a copy of your book, Get Rich Investing in Toronto Condos. It's something that I resonate with, and it's also something that I like to preach with my younger clients. But yes, I'm finding now that, as everyone kind of knows with the market and where prices are going, that the bank of mom and dad has become important for our younger generation to get into the real estate market. It's not a bad thing. Yep. It may not be the great thing, but it is the reality of a time period of which we're living in an area such as Southern Ontario. So yeah, I think this is definitely a topic that is important to cover. And we see with the increases in the volume of reverse mortgages in Canada, that it's going to be something that's going to continue to grow as the years go on.
Perfect. Yeah, they are getting more popular. That's excellent. So just on that note, for the folks tuning in, just in your own words, like what the heck is a reverse mortgage in layman's terms?
Yeah, I mean, a reverse mortgage, I really don't like the term. I really like the bracketed term, which is equity release. It just simply allows people to access the equity in their home without having to make any payments. So when you think of a typical standard mortgage, right, you receive a certain amount of monies from the bank to help you with a purchase or for whatever reason that you're getting a loan for. Mm-hmm. So you pay down a mortgage. A reverse mortgage is exactly the opposite. You can extract either lump sum or weekly, quarterly payments. So instead of having monthly payments to pay down a mortgage, you're actually increasing what you owe back to the lender. There's 3 lenders in Canada that provide reverse mortgages. So everyone may know from the commercials, your CHIP Equity. Right. The Equitable Bank also is a provider of reverse mortgages. And new to the show is Bloom Financial, which also provides lending. So
excellent.
Yeah.
Good. So why would I choose a reverse mortgage, for example, with its higher interest rates over, let's say, refinancing or perhaps something like a HELOC, home equity line of credit?
Well, again, here, this is where it becomes interesting because a reverse mortgage really targets a certain audience. Not everyone is able to get a reverse mortgage. Okay. So there's two principal criteria. You have to be at least 55 years of age to access a reverse mortgage.
Yeah.
Right. So anyone who's on the title of the principal property which you own,
yeah,
has to be at least 55 years old, and access to the equity of your funds cannot exceed over 55% of the value of the home. 55%.
Okay.
Yep. So again, the criteria is tight and concise for each of the lenders. Now, one in the field, Equitable, allows up to 59% loan to value that you have access to, right? Standard fees and costs are pretty similar across the board. So that's where, let's say that's the criteria for it. Now, why would I choose a reverse mortgage over refinancing? Well, as we get older in age, so people that are, say, in their 60s or 70s, we can assume that they're not working the job that they normally had.
They should be retired, hopefully.
They should be retired, hopefully.
Yeah.
But for most people on old age security or Canada pension plan, it just may not be enough, because to qualify to refinance or a HELOC, the misconception is always, well, I have all this equity in my home,
Right.
and therefore I'm entitled to it. Yes, you are entitled to it, and yes, those rates are lower, but the biggest caveat there is that it is income based. It's an income based financial instrument.
Right.
Whereas in a reverse mortgage, it's the loan to value on your home, the location of your home, the value of your home, and your age, right?
Okay.
So you don't have to have any income whatsoever. So I just want to just put a brief example that, and we know this, especially in Toronto, that there's people that have lived in their homes for, 10, 15, 20, 30 years, maybe have no mortgage or very low mortgage,
Right.
but are no longer working, or the significant other no longer working.
Yeah.
And
so
maybe
just-
adding an extra, excuse me, sorry.
No, sorry to interrupt. Just so I understand this correctly. So you're saying that even though I may have a lot of equity in my home, because now I'm, let's say 67 and I'm retired and I'm not making an active income, it would be harder to qualify or not qualify at all to be able to actually get money or a HELOC or refinance my home, even though I have all this equity. So just so I understand this correctly here, with a reverse mortgage, you don't have that same income-based qualification, so it'd be easier to actually get the money out. Is that a fair?
Yes, Rick, you covered that correctly, and that's exactly what it is. So when you hear, even when you see, everyone, I'm sure, gets prompted on their computers, get qualified in 30 seconds or 60 seconds. It's a very simple instrument for me as a mortgage agent, and people that are in this field will understand that it's because it's income based. So you make, for example, $100,000 a year. You have great credit.
Right.
You have no or very little revolving credit. What I mean by that is a car loan, your credit cards, other unsecured lines of credit, secured lines of credit.
Right.
You need to absorb all of those things to qualify to refinance on the equity of the home. Whether it's $100,000 that you want to refinance or $1 million, everything is going to be based upon your credit, your income, and how your debt servicing of those revolving credits that I just mentioned look like when we create a file for someone. On a reverse mortgage, your property is appraised.
Yeah.
Right? Your mortgage amount is taken into consideration. You might have a little one, you might have none, right? It does not matter. So long as the house appraises at a certain value, then the age that you're at then determines the amount that you're able to extract up to of a reverse mortgage, again, up to the maximum of 55% loan to value, or with equitable up to 59% loan to value.
Do they subtract out, for example, if I did have a car loan for, let's say, 30,000, does that come into the equation at all?
No, it's only on, if you ask me instead of that, but if there were, say, $100,000 left in your mortgage, right? A reverse mortgage is always in first position, meaning that you would have to have your remaining mortgage absorbed by the reverse mortgage. So if you qualify for $500,000, that $100,000 is absorbed into that. So there, yes, you are going to be paying a higher interest where you were paying one less. But again, the reverse mortgage product is for people that want access to the money, right? Okay. So I want to put the impression that it's not, it may not be for everyone.
Gotcha.
Right? But it can be. But it can be for everyone, depending on what point they are in their life, or what type of help that they need, or they've come into certain debts or payments that they no longer have the means because of lesser income, because of their age. That this is a great a method to absorb all of that and keep you living in the house that you want to live in, which is also a very important thing to talk about today.
For sure. Okay, so then on to the next question I had here. How does a reverse mortgage help with my retirement planning?
Well, we always hear that the best time to invest for your retirement was yesterday. So that's whether you're maybe 25 years old and just entering the workforce, and up to a certain age where you're able to do it, right? So where I think the obvious is why using a reverse mortgage makes sense is because when you are planning retirement planning, so this could be your RRSPs, right? Your stocks, your mutual funds, bonds, whatever other instruments that are out there to invest for retirement planning. You have a certain amount that you've been either adding weekly, monthly, yearly to those things, right? Maybe some years you'll skip, maybe some you don't. But it's pretty tight in the sense of you have to work until a certain age to have access to those funds, which are then exposed to taxes. Right.
Yeah.
So if I have $700,000 or $800,000 saved up, and I'm thinking I'm going to live, well into my 80s, and I want to live where I am, right? And I have no mortgage on my home. Well, why would I sell or cash out? Again, this is where the discussion is going to change when we start talking about why am I actually doing it? What are most people using this product for, right? But if you need access to monies without affecting your retirement planning, you can keep that money exactly where it is without having it be exposed to taxes, because you're taking it out beforehand.
So in other words, I have, let's say, a bunch of money in my RSP, other investments. What you're saying is basically, why would I affect that, sell it, be exposed and have to pay all these taxes, where I can just leave it in there, allow it to continue to grow, and then rather the money that I need to live for my retirement and do things and, travel and live and pay for the day-to-day, use a reverse mortgage instead to fund that.
Right. And so you can imagine, where we are today. We are currently, as of the end of March 2022, we're in a little bit of a downturn.
Yes.
Right. And people that rely on those retirement funds, they're extracting money, and the value of their stocks, bonds, RSPs, mutual funds, what have you, are lessening. The crunch is going to be bigger for them, right? On the upswing, I would say it's the same thing. Well, it's my financial advisor, whoever it is that you invest with, is doing great work with your stocks, bonds, and everything else I mentioned.
Yep.
Why tap into that while it's doing great? The value of your home that you've paid down.
Right.
Now, we know that living in Southern Ontario, and not just the last 10 years, it's not just the last 15 years. We're talking about for the last, since the end of the Second World War.
Right.
Okay. We have enjoyed passive appreciation of 5% plus per annum, right? So in the last 25 years in the GTA, home prices are, and this is a statistic, have gone up 453%.
Wow, that's amazing.
So that's an annualized appreciation of 7.08%, which is to any mid to conservative investor, that's fantastic. Remembering that you didn't pay all of your house, you put a down payment on your home, and now you have all this equity in it.
Yeah, and you took the words right out of my mouth. Some people might think, oh, 7% or 6%, I make, more in the stock market and stuff like that from it. And again, you hit the nail on the head when you said that is, well, when you do buy real estate, you're not putting that full amount. You're using leverage, you're using other people's money, in this case, the banks, in a loan. So that that return really is amplified, where it becomes a much higher return. So
Right.
yeah.
And I mean, I think it's a very easy argument to make, because if I put in $100,000 and I'm making 7%, where if I put in 100,000 and purchase a property of $500,000,
right,
that 7% is applied to the 500,000, not to my down payment.
exactly.
Right. So over the course of years and decades, and again, let's keep in mind, we're also talking about this as an instrument for people to access money, not just for a win, right? So this is again where parents, they're seeing their kids go into the marketplace. I know that for a lot of my friends, I just turned 50 a few months ago. The discussion is, how are my kids ever going to afford a home? My answer is, well, you can help them now, right?
You led perfectly into you read my mind. You went perfectly into my next question. So let me just ask it as an official question as you answer it here. So, the question I had was, is a reverse mortgage a good option for a parent loaning money to help kids with their own home purchases or other long-term investments such as RESP, otherwise known as living inheritances?
Yes, I 100% agree that is what's going on, as statistics will show us. Again, 40% of first-time home buyers today, they are being loaned their down payment amounts from the bank of mom and dad. Again, mom and dad might have a ton of money just sitting liquid in their account and easy to write up a check for whatever is required. We know that in the Toronto area, that living inheritance, especially towards home purchases, is around $200,000. In the Vancouver area, it's more in the 300. It's over 300,000, around $340,000.
Wow.
So you're talking about kids that have just gone into the workforce. Some of them are making great money. Again, you're not just helping your children with the down payment if the child cannot absorb the remaining principal and pay the interest and have those monthly payments. Right. But I get clients, Rick, that between husband and wife are bringing in $280,000, sometimes more. I had one client around $400,000, but okay, not a different discussion can be made about saving habits and whatnot. Yeah. Right? But sometimes just, life just happens and they just don't have enough for that, that down payment. And as Toronto inches more and more towards properties, all being $1 million plus for, as far as the guidelines and policies are concerned, as of end of March 2022, you need 20% for any property priced at $1 million.00 Right. So you're still, to even look at that property, you need $200,000 to put down as a down payment. Yeah. Now, if mom and dad have access to that money, via, like, each parent wants to help their kids. Let's face it. Yeah. Right. Sure. And part of this discussion has to quash also, the part where there's an ignorance towards or misconception towards this product, because they think that it's harmful. Right. Yeah. Like for example, like, who owns my home if I take on a reverse mortgage? You so long as you live in your property, there's a couple of things, couple of criteria for the homeowner. Mm-hmm. Okay. Number one, if you live in the house, you are the owner of your home. Okay. Okay. The bank has never, misconception was that the bank took over the ownership of your home. Right. And full disclosure to anyone here that has a mortgage, if you have a mortgage, I own 6 properties. I have several mortgages. So long as there's a dollar and there's no discharge to your mortgage, it doesn't matter if it's your standard typical mortgage or a reverse mortgage. In the end, you're still responsible for the payment back to the bank. Now, back to reverse mortgage, your house has to be kept in good shape. It cannot just go, it cannot fall into disrepair. So it's appraised as such. Okay. You have to be up to date with your home insurance. You have to be up to date with your property taxes, right? And you have to utilize this, quote unquote, principal property as your primary home, meaning you have to live in that home for at least 6 months out of the year, right? So you could be a snowbird, and that's fine, but your principal property, you're living there. That's your primary address, and you're living there at least 6 months of the year. So you always retain ownership of your home, insofar as the criteria that I just spelled out is maintained.
Okay. And what about the repayment of the loan? How does that work?
Well, so another interesting fact, Rick, that I find interesting is, 93% of Canadians age 60 and above want to remain in their primary home for as long as possible.
Yeah.
Okay.
So most reverse mortgages are paid
Upon like an estate sale. So, let's get into that topic. Now, both homeowners will have had to pass away before a reverse mortgage is then called upon, right? And there's ample space between the passing of the homeowner and the estate sale to make sure that there's no penalties accrued because of the time that's required for an estate sale. But that's basically it. Most reverse mortgages are paid upon the death of both homeowners. Can you pay down a reverse mortgage if you like? Yes, in the short term, there would be some penalties, as there are prepayment penalties for fixed rate mortgages of a standard type mortgage.
Yep.
Right? But on the long term, if you get to year 4 and year 5, there's no penalties. So if there's some way somehow that you had either a windfall or for some other sales of other stocks, bonds, you wanted to pay down your reverse mortgage, there are avenues to do that. So you're not restricted to not paying it off, right? It's just kind of the when. And for people that are interested after and they want to get into a little more detailed discussion, they can contact me for that.
For sure. And I will definitely leave your contact information in the description of this video. Now, before we wrap up, I'd like to go into some concrete examples. And from what I understand, you've prepared a couple of examples for us, so we can jump into those. So let me just pull those up here for everybody. Okay,
so Rick, and for all the viewers, let's look at this first example. So we have the estimated property value of $1.6 million. Okay, so we're looking at a fully detached house in Mississauga, a semi-detached house in Toronto, right? Homeowner age, number one, the Mr. is 62 years old, Mrs. is 59 years old, single family detached. So this will be, again, looking like Mississauga, which would be at the location type, a metropolitan, a large urban area. And again, the estimated property value of $1.6 million. We're going to assume here that there is no mortgage to this home.
Perfect.
So you see here, Rick, that from that example that we used, from the ages of the homeowner and the value of the home and the location in which it finds itself in, and the type of property that it is as well, these clients are going to be eligible for $536,000.
Wow, that is a nice chunk of change to be able to have some freedom to, help children out or help with retirement or both.
So here we jump to this great chart, which is, I think, something, that most people are going to appreciate. Okay, so for one, we're looking at a 6.14% interest rate. Okay. We're looking over a 10-year span. So we began at $1.6 million, and you're able to extract $536,000 as a reverse mortgage. Right. So your home equity that's remaining after you take out that amount And then we'll discuss, Rick, please, we're going to need the time to say that you don't have to take the entire lump sum if you don't need it.
That's just the maximum.
This is maximum. You're taking it out. You want it in your account. This is what gets deposited into your account.
Okay.
Your home equity then goes to $1,064,000. So again, you're only able to take up to 55%. And the example that we use with the ages is important here before we jump into the next example, because the older you get, the more money you're going to have access to.
Understood.
Right?
That makes sense.
Okay. So you see that in 10 years, again, we just said that over the last 25 years, the year over year appreciation is at around 7.08%. So in this example, we trimmed down the fat a little bit to 5%.
Just to be more conservative. Yeah.
Just to be more conservative.
Gotcha.
And we can play around, but I try not to go too unrealistic, because at the end of the day, this is where we live. These are the statistics that are real. And again, if you fit the criteria and the house is kept and everything else is as it is in terms of the market, 5% is a very fair passive appreciation growth in a large metropolitan area. Okay,
yeah.
So in 10 years, you would see your value jump to $2.6 million and above. For some people that have never purchased a home, they say, wow, like, is it really realistic to do that? Well, my easy answer to that, and I try not to be cheeky about it, but ask somebody in Toronto that's owned their house for the last 10 years and ask them what that home price was 10 years prior. Oh. And you'll see that these numbers are true.
Absolutely.
Okay?
Yep.
So even after 10 years, and yes, at 6.14%, you've accrued $445,319. So you're almost $1 million between what you were able to use and what you have to pay out. Okay? But your home equity at that point is now 1.6 million and above.
Right.
Okay? So 10 years later, your home value is valued a little bit more than when you first started. But in that time, if that $536,000 has served you well, or served your children to purchase their real estate, to grow their wealth, to help out your grandchildren with RESP contributions, it could be towards your life insurance contribution. It could go towards, just doing some things that, like, dare I say, living your life on your terms, whether that be travel. You can renovate your house with that money. You can renovate your backyard. You can do what you want with that money. So, I think, Rick, for this second example, it's going to become even more impactful. So I really wish that the viewers or listeners, the audience in general, are keeping also attention to the discussion of the garden suite. But again, the access to money at this age here. Now we have the male at 75. You have the lady at 70, single family detached in a metropolitan or large urban area with an estimated property value of $1.9 million. So you see the difference. Okay, the house value is around $300,000 more, but the age group here also will allow you to access more money. So here again, don't have to do it all as a lump sum, but if Mr. and Mrs. At this example, this is $818,900 being deposited into their bank account. Okay, so here we jump from the value of the home to 1.9 million. Okay, so we see there that the mortgage principal at $818,900 that could be received as a lump sum. Again, full disclosure here, you don't have to take out that entire amount. That's what you would be able to qualify for. But these are those monies within that $818,900 can be done in installments, weekly, monthly, quarterly, yearly, as you wish.
Or you could take a lump sum and then part of it lump sum, part of it, like you said, monthly if you want.
Right.
Okay.
So if you needed to, you had two kids that both of them needed a start, and both of the properties that they're wishing to purchase, whether it be a condo or a home, depending on the area that they're in, they're at that $1 million threshold that we discussed before, based on the policies and guidelines of today. Your kids will each need $200,000 each,
Okay.
right? So
So
you would
that's
still
just-
have
Yep.
$418,000, almost $420,000 to still do what you wish. Again, same examples as before. You can renovate your house. You can use it for travel. You can buy yourself that little that little house in Florida or another vacation spot. The money is yours to use freely as you wish.
Okay. And Marco, just something you touched on before that just wanted to reiterate and make sure that I got straight here. That 818,900 is the maximum. So in the example that you just illustrated, which is a great example and a realistic one, you can take, for example, 500,000 only. You don't have to take the full amount. You give 200,000 to each of your kids for what they need towards their homes that they're going to be buying. And then, for example, that other 100,000, right? The couple, they can, use it however they like. They can travel the world, buy themselves that new car. They can, renovate the home, update it, use it however they like.
And that's exactly it, Rick. And again, all with the benefit and not having a monthly payment. And just as important, that if you cannot qualify to help, even though that equity is still in your home.
Right.
So this is very important to the viewers and the listeners, that this exact example, right? If we were discussing a HELOC or refinance, right?
Yes.
All these numbers would, except for the mortgage principal, changes, because that mortgage principal is going to be based on the income. I just did a HELOC for a couple out in the Hamilton area.
Yeah.
Right. The wife was still working. The gentleman's retired. Zero mortgage on their house. No payments. Stellar credit, well into the mid 800s. 900 being the top score.
Right.
And their bank, a tier 1 bank, would not allow them anything as a HELOC. Never mind a limited amount.
Wow.
Zero.
So then, by the sounds of that, then if they really wanted to help their kids or do something,
It is impossible.
this
impossible.
This is the only solution, is a reverse mortgage.
I was able to get them another HELOC from another lender, right? It's still a Canadian bank under the same auspices and under the same guidelines and restrictions of everything that is a lending service in this country, right? So this is not a private. This is not a private loan. This was not some kind of alternative lending instrument. It's a HELOC, a home equity line of credit, like all our big 6 banks sell. But one of these big 6 banks told them, clients of 25 plus years, they weren't going to get. They were going to get a really nominal amount. And I was able to use other lenders. I have access to over 24 lenders, apart from working at Cat Mortgages. Cat Mortgage is also associated with Mortgage Centers of Canada. So we have access to, dozens of lenders because of the amount of volume that we do as an entire group under this umbrella. Right.
So even traditional mortgages, you're able to help anybody that needs your assistance in just regular mortgages. And the advantage of yourself, unlike just dealing with one bank, is that if you have access to many different institutions, truly working for the client, better being able to put them with the right product or circumstance.
And I expressed to this couple that honestly, the only other way that they were going to be able to do what they did, if I was not able, or if really all the doors closed because they needed a certain amount,
right,
it would be a reverse mortgage.
Right.
and again, with no payment to them. And they're actually kind of pondering it for the next stage in their life, because they definitely had no idea of this product.
For sure. No, that sounds good.
You know,
So then walk us through this then. So this is the scenario. We've got a couple in the 70s. They're able to borrow up to a maximum of 818,900. So what happens here in 10 years from now on this example?
Well, you're paying it's a reverse mortgage. You're paying out the interest and the money that was lent to you, right? So you get to your home equity, right? So when you're all said and done, right, you still have $1.6 million coming from the sale of your $3,094,900 home.
Okay, so in 10 years, this home, based on the example that you said before, you're using 5% conservative appreciation. This $1.9 million home is now worth almost 3.1 million. And so let's say in this example, in 10 years from now, I'm the son, my parents have passed on at this point, and do I have the option to move into the home, or do I have to sell it? What do I owe? Like, how does that work?
You owe the principal and the interest as you do any mortgage.
Okay.
Right. And then depending on what you want to do with that home, if you find yourself in a position in life that you're able to absorb this and keep it for your own family, understanding that, especially it's a nice story if you want to put the entire example that 10 years prior, this was to help you with your own real estate, right? So 10 years later, yourself and your sibling have that much more money. Maybe mom and dad bought that little condo in Florida, and it's worth X amount more, right?
Yeah.
Or maybe they put it towards their other retirement portfolio, their stocks, bonds, mutual funds, and they've accrued to a certain point.
Yeah. So
you're going to inherit that. You're going to inherit that as well. Now, if the house is that important to you to keep, and you have the means to qualify and absorb that expense, you can keep it. If not, you sell it. And again, what an incredible legacy. And again, not forgetting, because I think it cannot be lost here, that the primary reason why we're doing this is to help mom and dad. It's not just that mom and dad are helping you, right? They are helping you, and they want that.
Yes.
Their emotions, their love for you want that. But if mom and dad also want a Cadillac, or also want to travel the world, also want to renovate their home, also want to, pay for their grandkids' RESPs, whatever satisfaction that they
Go to
want.
Florida for 3 months in the winter and not freeze their butt off in this Canadian.
Whatever it is that they want.
Yeah.
Right. It's crucial that we underline that it's not just for the benefit of others, right? It's also for their benefit, because again, to have access to that kind of money, right? You need a significant income.
Yes.
But even if you had that significant income, and you don't want to, and you're that conservative that you still don't want to touch your investment portfolio or other things, right? At the price of 6%, so be it.
Right. This is fantastic. So it's a win-win situation for parents and the kids. Down the road, unfortunately, it's a inevitability of life. So in this example, down the road, the parents pass away, the kids have this home valued at 3.1 million. They pay off the reverse mortgage, the mortgage principal and interest, and now they have almost $1.6 million from this, in which to now, in this example, use however they like, and be in a position to also help their own children possibly as well, and the cycle continues. So this is great.
That's and that's a part that again upsets me, that the discussion of legacy always seems to be centered around super wealthy people. I mean, how do people become super wealthy? And let's not get into the Rich Dad Poor Dad books and all the other things that have been written over the decades, but it's just educating yourself to what's out there.
Absolutely.
Right? And the products that are out there, and people that are homeowners. Again, I bought my first property before my 25th birthday. 25 years later, I've purchased 7 properties, 6 of which I still own, and it's incredible to see where your life started at that age, to sacrifice and to work towards putting your money aside, because everyone here again has heard it before. This is what we call forced savings, a mortgage. It doesn't have to be a negative term. You have to make it work for you and for your lifestyle.
Absolutely.
And I just don't see enough education in it. And like I was reading in Canada.ca, what's an alternative that people should consider rather than a reverse mortgage? Like literally trying to dissuade people from the product.
On that note, so let's get into that now. What are the main criticism, would you say, in your opinion, of reverse mortgages and alternatives that that are suggested? Sorry.
One of them is the interest rate. Now we see it there, right? So today's 5-year fixed on a regular mortgage is around, it's almost 3.5%, depending on the lender.
Right.
So at 6.14, yes, it is considerable. But just like the market works for interest rates on your standard mortgage, so it does on a reverse mortgage. So where interest rates go up with your standard mortgage, they're going to go up just as well on the reverse mortgage. As they trend down, the same trend applies also to reverse mortgages. Reverse mortgages don't have to be fixed. They can be variable with the prime rate plus 2.5, 2.7, 2.9. So you can still be in the high 5s, but we use an example so that we can make an impact to the discussion.
Right. So they can be fixed and variable, correct?
Right.
Okay.
But the where a HELOC or refinance, so the HELOC, home equity line of credit, that yes, you do have the benefit of depending on the amount and depending on the lender, because a lender might even want to have a fixed portion, right, where there's a monthly payment going towards your principal and interest, and only one component for the interest amount only.
Okay.
But even assuming that you have a complete interest only amount, your home equity line of credit or refinance amount, again, assuming the loan to value of your property, yes, you can refinance up to 80% on your home. But if you're not able to afford that because of your income, I can't stress that enough, right? Without that income, you can have all of the hundreds of thousands, if not millions of dollars in equity in your primary property, and you have no way of accessing any significant amount, right? Again, so that you can also live your life. It's you speak to people that have had their mortgage for 20 years or 25 years or 30 years, and it seemed like that the worst thing to do would be to go back. I think that's our culture. Right. I always thought, and I think our generation, Rick, is going to be more poised to say, after working that amount of time and for what you needed to do to be where you are at a certain point in life, do you not want to enjoy it? So that if it means that it's going to come out from the equity of your home, so why say yes to it as a HELOC or refinance, but not as a reverse mortgage? Well, the interest rates are lower, but the other one, well, I can only access this amount, so maybe I can only do project A Where with the reverse mortgage, I can pretty much do maybe A to Z, right?
Well, yeah,
Depending on where you find yourself.
and like you said, that's the big thing. With the reverse mortgage, you're not, unlike the traditional refinancing or HELOC, you're not actually, especially being on a fixed income at that point, you're not actually paying money out each month. You don't have to pay that money, so your standard of living is just increasing and not going the other way.
Right. It's exactly that. And if, again, at 6%, at 6.14%, if you're in an upswing in the market and your investor group or your financial advisor, or however way your wealth manager is placing your portfolio,
Yep.
you might even be able to leverage off a little bit of that to gain. So even if it's 1% more or 2% more over time, again, giving you the ability, if you wanted to, so it's not that you can't pay down a reverse mortgage, right? It's just that you don't have to,
Right.
if you don't need to. So I take offense when I look at Canada.ca and it's telling me to downsize, move into a smaller home, move into a lesser expensive apartment, maybe think of it a retirement center. I just finished telling you a few minutes ago that 93% of Canadians don't even want to move out of their home. 93%.
And not to mention, if they do that and downsize or sell and move into a retirement home, and now they've just lost that ability of their 1.5 or 1.8 million dollar home of continuing to increase.
Gone. It's gone. And for the kids,
right.
It's not that selling it, because now the kids are going to, because for anybody who has the experience of what it is to pay for a retirement center or just to pay the rent, again, people are living longer. So your parents are not going to be, here's hundreds of thousands of dollars that we might have to ask for it back.
Right.
Right. It's again, if this is where it becomes personally attached to a specific story. Right. And I invite your viewers or your listeners to contact me to discuss it, because it's, and I'll be also completely transparent, for a reverse mortgage for the providers, it's usually a four-part interview, right? First, it's a discussion with the kids, then it's a discussion with the parents. Then it's vice versa. It's either the parents inviting the kids or the kids inviting the parents for a second meeting. Third meeting is to absolve and answer all questions.
Right.
And it's usually if it gets to the fourth meeting, that's where people are seeing the value in it and moving forward with it. It's an over $20 billion industry. And again, looking at what you can take. For some people, maybe it's you don't need to help your kids, but I would like to have an extra $2,000-3,000 a month, $4,000 a month, $5,000 a month, which is $60,000 a year. In 10 years, that's $600,000. So you're still not even utilizing all of the monies that you were, apt to use. Not to mention, after those years, if you wanted to reset it again, you can. So it's not like it's a one-time, deal.
Right. Yeah.
So long as you don't exceed that 55% loan to value of your property.
Right. And I think, people deserve it. They've worked all these years. They've worked hard in their lives to build up, now they retire, and to have that extra, $2,000-3,000, like you said, a month to help with retirement is well deserved and makes a huge difference. So that's fantastic. So again, you mentioned about the 4 different meetings. I'm assuming they can reach out to you for a no obligation, free meeting with you, whether it be Zoom, in person, that sort of thing. So again, on that note, I will say, Marco, it's been a fantastic pleasure having you on. If somebody did want to assess their personal situation and whether it be parents or kids or both, meet with you on this, what's the best way that they can reach out to you?
Whichever way is most natural to them. So if they want to call me, they can call me. They can email me. As you mentioned, if you're going to put my contact information,
Yes.
I welcome it. I really, again, that first conversation in terms of what we did as far as the numbers go, those will be done in literally 2 minutes time. The discussion has to be, is it right for you? What it's going to be used for? And so long as it's centered along the needs of that person, whether it be, again, the parents or the kids, that's my favorite part of doing this, because I'm not trying to keep going back to my experiences in the last 25 plus years of being a real estate investor and what it's meant for me and my family and my kids. And then what I also see as a future option, where if you're not earning that income, right? So there's the other argument with this is, if you get to a certain age, you should take out the HELOC as big as possible but when your income is reduced, how are you going to make those payments? Is that the best way then to do that? So again, I love to educate people on the pros and the cons. Does it work for you or not? Based on the information always that you're giving me, the more transparency there's between the two of us, I like to put the argument much more in favor and for the reverse mortgage as against it. I don't see too many reasons why not to utilize it, and I can find a way to discuss it. And if it works, it works. If it doesn't, again, it's the person can contact me with no obligation and just to have the conversation.
Yeah, free, no obligation information. That's nothing wrong with that, and that's fantastic. So you can help anybody in Ontario
That's
for
right.
their needs, and that's great. Again, you've been a wealth of knowledge. I certainly learned a lot. I'm sure my viewers and listeners have learned a lot. They probably have questions. Again, put them in the comments below. I'll make sure that, well, Marco will see them as well. Again, the information I'm going to have in the notes of the description of this video. And again, I thank you very much. It's been a pleasure.
Yeah, thank you, Rick, and thanks to all the viewers and listeners. I look forward to receiving your contacts, your comments, and it's again, it'll be my pleasure to walk you through more of a detailed discussion that is customized to your needs or your parents' needs, or whoever they may, whoever those people might be that require some help, or at least access to knowledge to know what they're able to do with their principal property.
Perfect.
So thank you.
Knowledge means power. Thank you, Marco, and have a great week.
Thanks, you too. Thanks, Rick.
Bye-bye.